The stock market is currently closed as it is Sunday, January 18, 2026. Supermicro Computer, trading under the ticker SMCI on the NASDAQ, finished its last active trading session on Friday, January 16 at a price of $32.66 USD. This represented a significant single-day surge of 3.24 points, or an 11.01% increase. While a double-digit gain usually suggests a massive internal win, the reality behind this movement is far more complex and actually highlights the fragile dependency Supermicro currently has on the broader semiconductor ecosystem. Most investors looked at that 11% green candle and assumed the company had finally fixed its internal reporting and margin issues. In reality, this move was almost entirely a sympathy rally triggered by blowout earnings from Taiwan Semiconductor Manufacturing Company. This creates a fascinating tension because while the market is rewarding Supermicro for being in the right neighborhood, the company's own recent fundamentals show a business that is actually shrinking in terms of year-over-year revenue. When you see a stock jump like this, it is easy to get swept up in the momentum, especially on platforms like the Robinhood app or through interactive brokers' trading interfaces where the green charts look enticing. However, if we look under the hood, the expectation for Supermicro was that they would be the primary beneficiary of the liquid cooling hardware shift. The reality is that their first quarter fiscal 2026 revenue actually dropped 15% compared to the same period last year, coming in at $5 billion. This was a massive miss against their own previous guidance, which pointed toward a $6 to $7 billion range. This gap between what management said would happen and what actually landed on the balance sheet is exactly why the stock is still trading more than 70% below its all-time highs, despite the recent Friday bounce. Smart traders using a Fidelity trading platform or managing their own individual brokerage accounts are starting to realize that being an AI server integrator is becoming a low-margin commodity business faster than anyone anticipated. The curiosity loop here is centered on the $13 billion in Blackwell Ultra orders that the company is currently sitting on. Management has used this figure to raise their full-year revenue guidance to $36 billion. It sounds impressive, but there is a major catch. Gross margins have compressed to 9.3%. For context, this is a company that people were pricing like a high-growth software firm only 12 months ago. Now it is behaving much more like a traditional hardware manufacturer, where every dollar of revenue costs 90 cents to generate. If you are using SoFi Active Investing or browsing investing sites to find the next big runner, you have to ask yourself if the sheer volume of orders can offset the fact that the profit per server is thinning out. The stock is essentially in a race against its own declining profitability. While the order book is full, the execution has been messy, with delayed shipments and high support costs eating into the bottom line. If you are currently holding a position or thinking about adding to one, I want to hear from you. Comment below how many shares of Supermicro Computer you currently hold and what your average cost basis is. It is helpful to see where the community stands, especially as we see institutional activity shifting. Recent filings show that some major wealth management groups have been trimming their holdings, while retail activity on the Robinhood stock trading platform remains high. This suggests a transfer of risk from the smart money to the retail crowd, which is often a warning sign of volatile floor. The discrepancy between the two groups often centers on the valuation. At a forward price-to-earnings ratio of around 14, the stock looks dirt cheap compared to the rest of the technology sector. But that discount exists because the market no longer trusts the guidance coming out of the San Jose headquarters. To understand why people are still betting on this company, we have to look at their actual business model. Supermicro doesn't just make boxes. They pioneered what they called the data center building block solution. Instead of selling a one-size-fits-all server, they allow clients to swap out components like GPUs, storage, and networking modules in a modular fashion. This was a massive advantage when the AI hardware demand first exploded, because they could get products to market faster than traditional giants like Dell or HP. They are particularly strong in liquid cooling, which is becoming a necessity as the latest NVIDIA NVIDIA chips run extremely hot. This technical niche is their strongest moat. However, the expectation that this moat would protect their pricing power has met the reality of intense competition. As larger players have caught up to the modular design trend, Supermicro has been forced to lower prices to keep their market share, leading to the margin squeeze we're seeing today. Looking at the broader landscape of online investing, many people use tools like Schwab Intelligent Portfolios or various Fidelity ETFs to get exposure to the server space without the single stock risk. But for those doing self-investing through Fidelity mobile app or Robinhood investments, the allure of SMCI is its high beta. It moves fast. When NVIDIA announces a new platform like Vera Rubin, SMCI often reacts more violently than NVIDIA itself. This is a double-edged sword. In 2024, that volatility worked in favor of the bulls, but in late 2025 and early 2026, it has been a painful slide downward. The recent Friday surge was a relief valve, but it hasn't yet broken the long-term downtrend that began when the company missed its revenue targets so significantly. For the stock to truly recover, it needs to prove it can turn that $13 billion backlog into actual cash flow without further margin erosion. The institutional side of the house, particularly those using Interactive Brokers platform for high-volume execution, is watching the debt levels closely. Supermicro recently entered into new credit agreements to fund their massive inventory, which currently sits at over $5 billion. They are essentially betting the entire company on the hope that their customers won't cancel orders and that the supply chain for NVIDIA chips remains fluid. If there is a sudden slowdown in AI capital expenditure from the big cloud providers, Supermicro would be left holding billions of dollars in highly specialized hardware that loses value every month it sits in a warehouse. This is the tail risk that the bulls often ignore when they point to the low price-to-earnings ratio. A low valuation is only a bargain if the company isn't facing an existential inventory crisis. For anyone navigating their own investment through SoFi stocks or Fidelity mutual funds, the macro environment is also a major factor. Higher for longer interest rates have made it more expensive for Supermicro to carry its debt. While they have over $4 billion in cash, their total debt is almost $5 billion. They are in a net debt position at a time when they need to be spending heavily on research and development to stay ahead of competitors. This financial tightness limits their ability to do things like share buybacks or dividends, which usually provide a floor for a stock price during a downturn. Instead, they are forced to keep all their capital tied up in server racks and cooling manifolds. If we shift our focus to the future outlook, there are two distinct scenarios. In the bull case, the Blackwell Ultra rollout goes flawlessly, and Supermicro captures a huge chunk of the liquid cooling market, allowing margins to stabilize back above 10%. In this scenario, the current price in the low 30s is a generational buying opportunity. The market would eventually reward the company with a higher multiple as trust is restored. On the flip side, the bear case is that the company has become a commodity wrapper for NVIDIA chips. If they can't differentiate their service and their margins stay in the single digits, the stock could easily slide back towards the mid-20s. The reality lies somewhere in the middle. The company is a solid engineering firm with a great product, but it is currently a victim of its own success and the massive expectations that were placed on it during the initial AI frenzy. To wrap this up, the 11% gain we saw on Friday was a much-needed breather for a stock that has been beaten down for months. It showed that there is still plenty of dip-buying appetite among users of the Robinhood app and SoFi investing platforms. However, one day of green does not fix a broken narrative. The contrast between the expectation of a $36 billion revenue year and the reality of a shrinking first quarter is a gap that only consistent execution can bridge. The management team has a lot of work to do to regain the confidence of the analysts on Wall Street, who have mostly moved to a hold or neutral rating. They need to show that they can manage their inventory without taking massive write-downs, and that they can compete with the larger scale of players like Dell without gutting their own profits. For those of you using interactive brokers' fees as a metric for your trading costs, or those looking for investment help through Fidelity Wealth Management, the key takeaway is that SMCI is currently a high-risk, high-reward proxy for the entire AI sector. It isn't a set-it-and-forget-it kind of stock. It requires active monitoring of the supply chain and quarterly earnings reports. The Friday price of 32.66 USD is a pivot point. If it can hold this level and build a base, we might see a run back towards $40. But if the next earnings report shows another revenue miss or further margin compression, that 11% gain will be forgotten very quickly. We have seen how the market moves on sentiment, but the long-term value of any company is found in its ability to generate cold, hard profit. Supermicro Computer has the revenue potential, but they haven't yet proven they can translate that into consistent earnings for their shareholders in this new, more competitive environment. As we move through 2026, the distance between the market's expectations and the company's reality will determine whether this stock returns to its former glory